The Asian markets are pretty mixed right now as things stand at the open.
Tax on face value of chips purchase may impact chip sales value at entry itself.
The GST rate on food items and beverages will be at 5%.
Nazara is a very well diversified gaming platform.
Hanging on to 19,500, up about 50 points on the index.
That probably the markets are looking a bit toppish from a near-term perspective.
Everything that we sell in cinemas on F&B will be taxed at 5%.
Too much access at one place and still deficient in other places is not a very good omen for agriculture.
Walt Disney is exploring strategic options for its Star India business.
Good news is that some green has come back on the screen because when the market opened immediately after, we had that bit of a negative tip coming in.
Fortunately, the NCLT has approved the amalgamation scheme for Max Ventures and Max Estates.
Well, first, the headline poll number itself is going to be 4.6, which is bad when you think that the last number was only 4.25.
Quadria Capital is investing around 1,300 crores in South-focused Maxi Vision Eye Hospital.
Slide from the top that we are seeing on the Nifty as we speak. It's up 10 points.
Well, that was the day so far. Hello and welcome to Closing Bell. I'm Nigel D'Souza and joining me is Rima as well as Surbi. Well, that's sort of a day, right? We thought we were going to be going to around that 90,500 odd mark. But the markets, we only have 60 minutes to go towards the end of the session today. And we have not moved too much. We have moved, 5 or 6 points. That's the kind of trading session it's been. So it seems, at least for the day, the Nifty is in that range of around 19,400, 19,500 odd. But don't just look at the headline index. Individual themes are still playing out, and they're playing out in style. The defense stocks, well, they are on the offense. Just pull up some of those stocks. You look at Zen Technologies, Mazagon Dock. We're talking about stocks that have already given you 50-60% returns already, and yet they're getting in today's trading session big moves out there. And the Nifty IT index, Rima is going to have a very, very busy evening. Well, the index itself is consolidating a little bit, but a couple of these numbers will be interesting to see because HCL Tech, there has been a lot of weakness going into these numbers. And Rima as well will tell us about the expectations on TCS. So that's sort of a day, right? Quiet on the headline index, but otherwise individual stocks still doing their thing.
We potentially have a lot of market-moving events in the evening, right? You spoke about TCS and HCL Tech. You've got inflation, and considering the way vegetable prices have gone up, the June CPI print will be important, and plus what economists expect going forward in the month of July. And then you've got the US CPI data. So these are potentially market-moving impacts. Market-moving events. By the way, just ahead of numbers, TCS is seeing some buying. Pull up the intraday chart of TCS. TCS has recovered close to about 1% from the day's low and is now back in the green with a gain of about 0.25%. Wipro has seen some buying. And Kotak Mahindra Bank. In the large cap space, Kotak Mahindra Bank has had a fantastic second half of the trading session. Just a minor downtake, a nick of some profit booking in the last 10 minutes. But look at the chart since 12 a.m. That stock has been very, very resilient. And on the losing side, HDFC Limited, last day to trade before it gets merged into HDFC Bank. So if you have shares of HDFC Limited, you will eventually be holding shares of HDFC Bank basis the swap ratio. But HDFC Bank a bit subdued on its last day. No flourish.
No flourish, flat market. Guys, what market are you talking about? I think I'm in a different market altogether. I'm just going to throw in some names out there. Literally, I can't make head or tail of what you guys have said. Look at what's going on. Mankind Pharma, 8.6%. Mazagon Dock, obviously, what to say about that stock, 8.5%. PB Fintech, 6%. Sirma SGS, some of these new EMS, electronics manufacturing services play, 7 to 8% higher over there. Zen Technologies, 8.5% higher. Let's talk about some of the financials, some of the banks. South Indian Bank, almost 9%. JNK Bank, 6.5%. Punjab and Sindh Bank, 6%. Ashoka Buildcon, 6%. Short point, I think viewers, you've kind of got it, by now, that this is a market which is moving on steroids beyond the Nifty. And the Nifty is a little quiet because of the events that, of course, Nigel and Rima alluded to. But I think it's a market where fund managers have nobody's looking at the Nifty 50 stocks. Out there, it's a wild rush, I think, to just lap up, make sure that you've got, all stocks in. Because earlier, Nigel, I remember, it used to be, a few stocks which have so much price and volume action, so much momentum. But now, as I said, I'm still breathless, and my list is not even half done on the mid cap and small caps.
On the large caps, so we just briefly mentioned HDFC Limited. It'll be the final 60 minutes that it'll be trading in this sort of avatar. I just want to give our viewers some bit of trivia. HDFC Limited was founded in 1977 by Mr. H.T. Parekh, who's the uncle of Mr. Deepak Parekh. What's most special is Mr. H.T. Parekh, well, he founded this company, or he formed it at the age of 65. So it's never too late, right? And today it's going to be signing off. HDFC Limited will be signing off. This is the last day it'll trade in its current form with a market capitalization of, hold your breath, 5 lakh crore rupees. So that's the kind of move that we've seen. Yes, the last 60 minutes will be important, but otherwise it's played a very, very good innings in the stock market as well.
And the number of businesses that it's incubated and seen to such a large extent, right? You've got an HDFC Bank, but even in the other financial, HDFC, AMC, they've got life insurance. They've got presence across the board now.
Absolutely. And pedigree, I think what HDFC has exactly taught us is pedigree, trust, doing the right thing for your borrowers, for your lenders, for your shareholders.
Across cycles.
And wealth creation across decades, across cycles. So I think, I'm glad you brought this up, Nigel. And it's really a special 1 hour.
And I think one of the themes was when he was set up the company, was people used to wait to retire and then look to buy their house. That people can start buying their house itself. So, you can purchase the home that you want. So final 59 minutes odd is what you're going to be seeing HDFC Limited trade in the current avatar. But let's find out about today's trading action. Then Mitesh Thakkar joins us on the show. Hi, Mitesh. Well, we have been talking about a quiet day on the index. Your reading of the index move first, and then I'm sure you have a couple of picks for us.
Nigel, you're right. I think the index is very quiet. But what is good is that the bank Nifty has, started showing signs of a mild pickup. Yesterday's low was around 46,663, and today we got a low of around 46,683. So I think, if the bank Nifty can reverse a bit, maybe, you will see the Nifty pick up again. But I think the breakout will take place only once we see the Nifty get past 19,530. So till then, just trading on a stock-specific basis with more of long bias. I have 2 buy calls right now. Syngene, and a disclaimer, it's a part of my portfolio. It's breaking out into a fresh swing high. So Syngene is a buy with a stop at 764 for targets of 810. And Tata Consumer, after a pullback, seems to be reversing. That's a buy as well. Keep a stop at about levels of 837, look for targets of around 870.
Okay, let's get to the big story of the day is that online gaming, horse racing, casinos will now attract a GST of 28%. Manglam is here with more details. Manglam.
Well, to tell you the regulation that has come by at the 50th meeting of the GST Council is that they've said casino, horse racing and online gaming will be taxed at a uniform rate of 28%. In fact, for casinos specifically, the tax will be applicable on the face value of the chips purchased, and tax will also be applicable on the full value of bets placed in case of online gaming. Analysts say that, taxing the value of chips purchased may impact chip sales volumes, and taxing full value of bets placed in case of online gaming may treat game of skill at par with game of chance. So that's as far as the news is concerned. Now the impact, the biggest of that is on Delta Corp, down 22%, the biggest cut that we've seen in the history of the stock, and it's erased all its gains from this year itself. And there is a threefold impact to that. One, paying 28% upfront at the face value of chips may be a deterrent for people to enter the casinos, as it would enable them to, have a 28% sunk cost itself at the start of betting itself. Secondly, they have a vertical called Adda 52 through which they were looking to unlock their value. But now with online gaming being taxed at 28% and the distinction between game of skill and game of chance being removed as well, that valuation will have a big markdown. And the third big reason, the stock is in F&O ban. So the long liquidators will not have sufficient counterparties to actually absorb their selling, and as a result of which the impact cost is a little higher as well. And that explains the 22% cut that we're seeing on Delta Corp. Nazara Tech has about 5% of its revenues coming in from real money gaming. This was a segment which was fast growing. So capping future growth potential in their real money gaming business is something that's impacting the stock. However, it's come off lows by virtue of the fact that it's just about 5% of their overall revenues right now.
Okay, all right, got that. Manglam, thanks very much. Big cut on Delta Corp today. Nazara also down about 3 to 4%. Well, Prakash Diwan is joining us on the show this afternoon. Prakash, great to have you on. As usual, I don't know, are you much into gaming, either online or in casinos? What do you make of everything that's happened today?
Thanks, good afternoon. No, so I'm pretty content with the adrenaline rush that the markets give you. Yeah, I mean, this was, something that was never put to rest in terms of, anxiety and expectation on how the government would respond. And the fact that they've finally come up with something, it takes the indecisiveness out, but it is a body blow for especially the operators, for the casino operators. 28% means you actually pay about, if you buy chips worth $1 lakh, you actually get about 72,000 worth chips. So, so it's distinctly a cost that's added on. Now, how much of this will be absorbed by the players, by people who like to do this? I don't know. It might take some time. So that's precisely why, of course, it's a pass-on cost. It's not something which they will be kind of incurring at their end and resting with it. But it will definitely lead to a huge slump in terms of, what people can do with this. So there's going to be a little bit of it'll take some time. But, the interesting part is the clarification that Nazara Tech comes up with, Surbhi. I think the market will probably try to pencil in that, do some deep dive into how their revenues could be differentiated qualitatively on the skill-based non-money games, this thing. And if that were to happen, probably you'll see some sort of a respite there in tomorrow's session. But as of now, I think you just have to kind of let it reel under this impact. Delta might find it much more difficult to make a comeback.
Prakash, any thoughts on how Delta might tweak its business model in order to find some loopholes?
So Rima, what's happening is that they are constantly evolving, and primarily it was triggered by the competitive intensity in Goa. Today you have, when Delta started, they actually had nobody to challenge them. Now you have about 6-7 other players also around it. So what they've done is they've tried to incorporate a lot of other verticals, including poker, which has become a fairly big contributor, as I hear from people who visit the casinos. I don't, as I said. But the information that we have is that probably the business model could get tweaked in terms of, what you get, what you pay for when you buy the chips and the winnings that come back to you. There could be some rationalization, some sort of a arrangement in that in terms of, if you don't win, then only this gets taxed. So some kind of, incidence of taxation changing on the expenditure part for the buying price for the players. And that might yield some sort of a respite. But I'm not too sure how that works under the spirit of the law. But if the GST were to be absorbed, it is definitely going to be, as I said earlier, it's a body blow. It's significant in terms of what it does to the company's revenues, and of course the fact that it will lead to a little bit of demand contraction as well.
Indeed, Prakash. So that's clearly a hard knock for Delta Corp, and we had a knee-jerk reaction on Nazara Tech, but that stock has cut its losses to nearly around half. Before we move on, just pull up a couple of these themes that have been playing out. The smart meter theme, well, all of last week, those stocks are moving around. Here, Genius Path that corrected close to around 10% from the peak that we saw last week. Now that stock in the last few minutes is a big volume pickup out there, and again, it's trying to make its way up. I'm not sure whether or not there is something that the street is reading into it. But in the last few minutes, that's one of the stocks that's moving higher and moving higher on very, very large volume. Smart meter play moving higher as we speak. Well, let's move on then. A large deal is brewing in the chemical and fertilizer space as Advent's Group is looking to restructure its listed companies. Nisha Poddar, she's been on top of that, and that's the exclusive that she's bringing us today. Nisha.
Thanks for that. Yes, sources with direct knowledge have shared with CNBC-TV18 that Advent's Group, which has multiple listed companies in the chemicals and fertilizers space, is looking at a large transaction within the group. Now, sources with direct knowledge have shared with us that Zuari Agro, the listed company, and has a controlling stake in Mangalore Chemicals, is looking to offload its stake and control in that particular company to another group company, which is Paradeep Phosphates, which is a newly listed company of this particular group. Now, remember that there is a complex structure of cross-holdings within this group, and Zuari Agro, in a joint venture with OCP, is also a shareholder directly into the Paradeep Phosphates, which is the parent company, a joint venture entity with Zuari Agro in it. So the idea is to merge Mangalore Chemicals and Fertilizers with Paradeep Phosphates eventually. But basically, Zuari Agro has been looking at options to offload this particular stake in order to raise capital and repay its debt. Now, remember that earlier we had reported that Zuari Agro had been in discussions with Chambal Fertilizer, which is also a listed entity of this Advent's group, in order to offload Mangalore Chemical shares. But we gather that that plan has been aborted because it was not tax efficient. So currently, advanced talks between Zuari Agro as well as Paradeep Phosphates to offload the stake of Mangalore Chemicals that Zuari Agro owns. We reached out to the company and we did not get any comment on this particular deal talk. Now remember, in this complex structure, Zuari Agro is a listed company, Mangalore Chemicals along with Paradeep Phosphates, a newly listed company, and Chambal Fertilizers, all four stocks get impacted with this transaction.
Okay, all right. Nisha, thanks a lot for that. Prakash, any view on any of these listed names? How do you approach it?
I think this definitely makes a lot of sense for Zuari. I mean, they've been left out in terms of this fancy for fertilizer names, given the kind of heavy balance sheet, the debt burden that they carry. They'll be able to utilize cash very effectively. And Paradeep Phosphates also is at a stage where if it were to be merged with Mangalore Chemicals, it's going to be something where the turned around situation of Mangalore Chemicals in terms of the balance sheet and the aggressive growth that Paradeep Phosphates is already clocking will kind of, have a very good synergy of sorts. So it makes sense. It's quite win-win in that from that perspective. But, Nigel, what I have seen about these names is that these are very long-term plays. I mean, they don't turn out to be promising. It's a cyclical thing which will take about 2-3 years, and the way the agriculture sector is getting technology intensive with so much of stuff being talked about, and I saw live how NSDC is actually utilizing technology to grow that kind of a phase. The utilization of fertilizer and chemicals in our organized agri space, even the unorganized for that matter, is actually going to grow multifold with much more efficiency. So it's something which happened to life insurance in India when the private sector took charge. So once these companies start getting some sort of scale, you will see a re-rating of these stocks, which otherwise they've been languishing in a very low PE band. So it's more of a secular trend, which seems like coming into its own, but it might take some time. It's not something which is very immediate. But you could stick to the well-established players like Chambal, for that matter, maybe a GSFC also, given its own salience in terms of the cash payback that it's doing through the government, through the new regulations that the Gujarat government has introduced. So there are a lot of these names which seem promising to at least take some bite into that space, lest you get left out.
Okay, all right, Prakash, stay with us. We'll come back and get some more questions going. But right now, a very quick break. We also get a conversation going with Shiv Sehgal of Nuvama Capital Markets on the other side. So stay tuned for that. Welcome back. Well, the market continues to be extremely range-bound. We are looking at some interesting brokerage notes that have stood out today. Nimesh is joining in with that. Nimesh, what's been on the brokerage radar for you?
I said this. Today's actually standard was on Kajara Ceramics. Interesting upgrade from Goldman Sachs. So today they've upgraded the stock to buy from neutral, and they've raised the target price to 1,500 versus 1,200 earlier. Now the upgrade is basically on a couple of reasons. One, on the back of favorable RE cycle, they believe 13% of volume growth will be there by FY26. That's the first reason. Second, on lower gas prices, which would mean that the EBITDA margins can improve by 300 to 400 basis points and benign domestic competition. Now, Goldman Sachs report says that while RE cycle and gas cost benefits are well understood by the investors, it's the export opportunity and the dynamics there which can be a big re-rating trigger for Kajara going forward. So that's the key reason they are bullish on. Now, even in terms of valuations, on FY25, the stock is trading at close to 31 times, and on FY26 is trading at close to 27 times, versus the average long-term medium is around 35 times. So the valuation is comfortable, and there is going to be a 600 basis points incremental ROCE improvement between FY23 and FY26, and the PAT CAGR for the next 4 years is going to be around 29-30%. So valuation comfort, earnings are going to be strong, and Goldman Sachs believes that the export opportunity is not well understood by the investors, and hence they have to upgrade the stock to buy, and they've raised a target price to 1,500 on Kajara Ceramics.
Okay, Prakash, any thoughts on Kajara Ceramics? The stock has anyway been doing well. It's a big play on home improvement, real estate demand, and a lot of people, investors, prefer to play it via the ceramics, tiles, and the home improvement segment rather than going down the real estate, the listed players. Do you think 1,500 is a possible target on Kajara Ceramics?
So the answer is yes, but from where it is today, the upside, given the risk reward, might not be very attractive. So what they've actually done is their own estimate earlier, which was I think about 1,200, has been revised, given the fact that it's already been in such a strong move, as you rightly said. So this is the pocket to be in. I'm not recommending Kajara at this point in time, given the rich valuation that some of these well-known branded players have. And they will always be, so Kajara is the Asian Paints on the ceramic side, right? But in the home improvement space, Rima, what I'm noticing is that there's a huge shift from the unorganized sector to the organized sector. And it is actually all of that improvement is going, all the incremental business is going to smaller players. The reason being that they still have price points which are affordable for the general masses. If somebody is buying an apartment for 65, 75 lakhs, he's not going to spend, 10 lakhs or 15 lakhs on a kitchen from Heritage or a Rafael or something. It's going to be more smaller names that will get attracted. So that's the segment that will grow faster, is my belief, and you still have a lot of value in that. So you'll have to do some deep dive there to find out the home improvement segment or the home augmentation segment. But that's the most promising way to play this real estate move, given the fact that the larger real estate players themselves are always going to be vulnerable to the cost of money shocks. If cost of money remains elevated, they really get impacted. But this segment is far more insulated.
Okay, got that. That's a take on Kajara. Prakash, a little sort of cautious about the valuations the stock is trading on. Speaking of interesting notes, today there was another one from Citi. Now, Citi has gone ahead and straight out gone negative on Pidilite. In fact, Mangalam is, I think, back with us. Mangalam, they've gone directly from a buy to a sell all the way. What happened?
That's correct, and that's surprising as well, because there's a double downgrade that has come in on Pidilite, and investors are usually very sticky to Pidilite, or the kind of moat that Fevicol brand and their businesses have. But they believe that, a large part of the margin expansion story has played out already on Pidilite. They've double downgraded from buy to sell and cut the target price from 2,800 odd rupees to around 2,200 rupees as well. And the stock is currently around 2,600 odd, recovered from the lows. The reason why they downgraded is that they say that FY24 estimates have already factored in margin expansion. The company usually speaks about a 20 to 24% margin band that they operate in, and any earnings growth beyond FY24 will likely be in line with the revenue growth of the company itself, and that would be anywhere between 12 to 13%. The company guides for or aspires to have double-digit volume growth every year. So maybe 12 to 13% is the revenue growth that Citi has been factoring in. And with all of this, the current valuation of 70 times 1 year forward earnings leaves very little room for any error and looks unsustainable as per them. The stock has recovered from the lows, but there is a double downgrade coming in, citing valuations and all the near term being priced in sort of concerns.
Well, Mangalam, thanks a lot for that. It seems all those concerns, they got gobbled into because the stock now is on the verge of moving into the green. So Citi believes that those multiples of 70 times or they're not sustainable, but it seems the bulls have latched onto the stock and bought into that dip. Prakash, that's about Pidilite, but let's focus on the smart meter space, because in the last 30 minutes or so, we were just talking about Genus Power, HPL Electric as well. I think we should pull up both those two stocks. I'm not sure whether or not there was any kind of positive statement or there is a tender that's been opened as well. Both those two have moved up. Genus has come off actually after seeing a bit of a spurt. But the other one that we're talking about, the other smart meter play, well, that's spiked up. Yes, HPL Electric, that's the one that we're talking about. I think it should come up for you on the screen. We'll fix that in a bit. Prakash, what's your view on either of these names, the space itself?
No, I think it's a space that suddenly has kind of opened up huge possibilities, given the fact that the government before the election year is trying its best to rationalize a lot of these anomalies in the market, the kind of leakages that you have. And given the fact that cost of power has been so high and elevated for a fairly long period of time, metering is a logical solution, Nigel. There's no way you can kind of avoid it. It's as simple as putting, toll tax on road construction, right? I mean, if you didn't have toll tax, roads wouldn't get constructed. If there's no metering, power growth cannot happen. Consumption cannot move into a more favorable kind of a thing for the producers and for the distributors. So here you have, in fact, it's just the beginning of a trend where I would believe a lot of the larger players will throw their hat into the ring as well. I mean, you have Genus and HPL of late coming into this space for some time, but you have the likes of Tata Power, which have drawn plans out to go into heavily into digital metering and all. So there's going to be a huge activity around this. Out of the two names that you just mentioned, I think HPL will give you much more comfort in terms of where it is and where it could go, given the fact that it still has a huge runway in terms of realizations to improve from this particular space, where they had the cables business and all, which dragged them down earlier. But that's also taking up a lot of, I'm seeing a lot of presence in the channels, in the sales channels beyond, the likes of Polycab and all, which are more popular. So HPL could probably give you a much more balanced kind of a growth as compared to Genus Power, which is dependent on only this particular sector.
Okay, all right. So, yeah, indeed, powered up and how some of these stocks that Nigel has spotted. Days high in a dull market. But as I said, it's never dull when you're looking at mid caps and small caps. Prakash, thanks very much for joining in today. Always great having you on the show. Connect with you later in the week. Well, let's carry the conversation forward. Shiv Sehgal, President and Head at Nuvama Capital Markets, is with us on the show this afternoon. Shiv, pleasure to have you on, and glad you could finally make it to join us on the show. We've been looking at some of the notes that your team shared with us. I mean, some of the data points which seem to suggest that you guys at Nuvama feel that we are in for a long ride. And probably more flows when it comes to India vis-a-vis other emerging markets. So lay out your theses and tell us that at 19,500 plus, can you stick your neck out and say that we will still be substantially higher, say, in the next 12 months?
So, Surbhi, firstly, thanks for having me on the show. As you rightly said, I think, before we get to where we are today and what the journey is going to be over the next 6-9 months or 12 months per se, I think it's very important to realize what transpired in the last 2 years, right? I remember, we've been talking about the significant FII sell-off that transpired in FY 22 and 23, right? And if you combine the cumulative net sell, it was almost $60 billion that foreigners took out of India, right? The flip side of that was we had an amazing domestic equity culture forming. And, that has been happening since 2016. And I think that, to me, was an inflection point in terms of, your financial assets, which are in the form of cash and savings, moving into the equity asset class or the derivative equity asset classes. And that trend has been going, right? And that is the reason why domestic mutual funds have seen almost a 10x growth in the last 10 years. This is exactly very similar to the developed markets in the 1980s when US was transpiring and there was a combination of demography and deregulation, which spurred strong retail interest in the equity markets. I think we are, maybe 2 decades, 3 decades behind, but that kind of, it is the same setup that is extending over in India. And that overlays with the fact that if you look at the rest of the world is starved for growth. And to me, growth is GDP, which is nothing but a combination of three things, right? GDP today stands for population growth, productivity growth, and debt growth. Now, as we all know, that for the last, 2 decades or maybe a decade and a half, the population growth in the developed world has been on a negative decline. There has been an aging population problem. So the heavy lifting in growth perspective was done by the influence of debt and a lot of productivity, which is in the IT space that happened in terms of AI, what we're talking about today, and which led to this whole passive money and active money coming into the likes of NASDAQ, right? Now, coming into this year, right, March of this year, you were talking about, everything was quite negative. Foreigners had been again selling. That transpired into two things. One was sentiment was, in my mind, extremely bearish from an overlay perspective in what had happened in terms of the US Fed rates increasing by 5 percentage points, which has never happened in the capital markets in a 12-month span of time. Plus, with the fact that if you look at the FI positioning in the NSE 500, we were at all-time lows of 17% ownership. That transpired. So sentiment and liquidity, along with bearish positioning, is a very, very powerful incentive for the narrative to change, which is what has exactly happened in March. So Nifty has gone from 16,900 to almost 19,400 as we speak. The mid caps have been having a very significant rally. Nifty is up 15%, mid caps are up 24%. To overlay that, your question, why suddenly India is the darling? There is also a lot to do with the fact that the rest of the EMs are having their own inherent problems. So India stands out as a darling. A lot of structural reforms and a lot of what we have debated on your shows, right, as to the groundwork that has been overlaid in terms of the digital transformation that India is going through, the regulation, the GST, the demon, that all that transpired. We have laid the foundation for the next leg of growth, which first transpired into FIs and domestics always putting money into India. And now we are going to see the multiple re-rating first happen, then the earnings catch up, which we continue to see. So last quarter, people were expecting to be a muted growth. But, if you look at what transpired, the banks came out flying, credit capex was happening, the NPAs were very low, balance sheets are very strong. Yeah.
Shiv, allow me to come in over there because we're a little short on time. That's yep. You've explained the setup quite well to us. But very quickly, what next? It's all about the future. The question is now at, I think, a little over 19 times earnings. Are you still expecting more multiple expansion? What are you expecting now? I mean, can earnings keep pace? Let's say, over the next 6 months?
Absolutely. I'm preempting your question, Surbhi. Valuations and momentum are two different things. Japan traded as a cheap market for a very, very long time, right? NASDAQ has been relatively expensive for a very long time. As we speak, I'm not sure if the audience has been following, the top 7 stocks in the NASDAQ are now making up, NASDAQ is about 100 stocks index. The top 7 stocks make up more than 50%. And the providers have now decided to rebal and cap because the index is supposed to provide diversification. So on 24th of July, there is going to be a diversification cap, which is going to reset. My point being that, India is just on the cusp of the inflow of money coming in, which will continue because we are a shining beacon in the rest of the world where growth is not happening. I think earnings will have to continue to match up. But at the moment, given what has transpired in the last 2-3 quarters, I think there will, of course, be pockets where we see, things run up, consolidation happen. But over time, the trend remains very, very positive. I think India will remain a shining beacon over the next couple of months and quarters. I have always been saying that India is a long-only market where any consolidation or dip that happens, you continue buying. As some of the smart investors have coming on your show, I've been kind of rehashing the same statement. I am of the view that we'll be seeing new highs on a constant basis. Of course, there'll be pockets where euphoria happens and there'll be some consolidation. But overall, by and large, given the fact that we are short on time, I can say that structurally, there are 5 themes that have been developing in India, which are not prevalent in the rest of the world. And at Nuama, right, as you rightly saw, and in every note, we keep talking about the India's 5D advantage, which to us is been rehashed quite popularly in the media as well, which is debt, deglobalization, deregulation, demography, and democracy, right? I think the confluence of these 5 factors structurally are forming a very, very strong base for India. And I think India is on the cusp of being the shining beacon for this decade. I'm not talking about 1 quarter, 2 quarters. You're asking me to give you a prediction for the next 12 months. I'm saying for the next 2, 3, 4, 5 years, I think India will continue to see a lot of influx of foreign flow coming in.
Shiv, good afternoon. This is Nigel on this side. You're clearly very, very positive on India for the next 10 years or so at least. And our time has come. So that's great news. I had dinner with a doctor the other day at NSE, and he was telling me, Nigel, I invested in the markets in 2019, 2020, and my portfolio is up more than 2.5 times. Can I expect that sort of a run rate? I was like, no, hold on a minute. I don't think that's really possible. He said, because I went to a couple of advisors and they are talking about 10, 12%. I said, over a longer duration, if you get that 10, 12% per year, that compounding is going to result into a lot. So a lot of viewers out there will be wondering if India is going to do well. And if you're investing funds into the market indirectly, that's via all the instruments that we have, what kind of a steady state return should you be looking at?
So see, normally GDP is growing at around 10, 12%, right? I would assume that barring the volatility, which is always going to happen in markets and the euphoria and the ebbs and flows, we also have a geopolitical event coming in terms of elections. The rest of the world actually is not growing that well, Nigel. That is extremely critical to understand here. India still remains a capital-starved nation. There's a reason why we are still an emerging market. Now, I've done a lot of study as and when poor nations become rich nations, emerging markets become developed. The one underlying factor that remains is that for any country to become rich, the common theme that has happened and which the US and the developed markets have done well over a period of time is they have built strong institutions that have outlasted bad governance or governance, right? That is very, very critical to understand. So as long as, the startup system and the risk appetite that has happened in India is going to generate a lot of these entrepreneurs. A lot of the large caps today were mid caps, 2 decades back. The point being, we will go from 3.6 trillion to 6 trillion. But I think if nominal GDP is going to grow at 10, 12%, a healthy state over a period of time, CAGR of 15%, 18% is brilliant, right? In a world where,
Okay, Shiv.
Yes.
Shiv, I'm sorry to butt in again over here because, your bullishness is taken on record quite well. A very small question, and I think we only have 30 seconds for an answer right now. While we take all your points on board, I'm just curious, what have you made of all this insider selling? I mean, June till we got into the earnings season, sort of, the block where you can't sell. PE guys are selling, insiders are selling, promoters are selling. So how should we read that? Is there any reason to worry about the near-term market?
So private equities had a torrid last 18 months. As and when they have mark-to-markets which are in gains, they will come to sell. They also have other startup portfolio companies which were supposed to get listed have not happened. I think that the IPO market in India is also about to open in the second half of this year. But having said that, if you look at the mid-cap index, we have come back to the highest, which was, almost at, January 2018. So we've come back to a level which was 5 years back. And as a result of that, you will see people come and take some profits off the table. As I said, India will go through a consolidation phase and then a euphoric phase. We went through a consolidation phase over the last 18 months. We are going, when I say euphoric, I think, a bullish theme. I think this bullish theme can last at least for a couple of months. The IPO markets have just opened up. The primary markets are just opening up. I think that will continue. And the fact that, not much is getting deployed in our, a very large neighbor, which is China, is helping India tremendously. As for me, the risk factor is what happens in Southeast Asia. We need to keep an eye on that. China is also, opening up the floodgates in terms of liquidity and easing. That can spur the markets there. And we'll see how India plays to that.
Okay, got that. Shiv, thank you very much for joining in today. That's a real bullish call on India coming through. Thanks for joining in. We'll take a quick break. On the other side, we get you a check on all the dealing room chatter today. Nimesh joins in, and then, of course, a couple of trading calls for the last half hour as well.
Well, the markets have moved to the low point of the day, but for the time being, let's cut across to Anil Agarwal, chairman of Vedanta, addressing the media at their 58th annual general meeting. Let's hear him out.
Resilience and delivered impressive result. It is in Vedanta DNA to view every challenges as an opportunity.
Well, we'll keep dipping in to see in case he says something important with regard to that joint venture particularly. Well, for the time being though, let's shift focus to our special segment, D-Street Chatter, where Nimesh is standing by to tell us how he's reading today's trading action. Nimesh.
Hi Nigel, very range-bound day of trade. I think Nifty has been ranging between 19,200 and 19,400. But in terms of flows, again, today will not be an important day from a flow perspective, largely because there's so much of adjustments happening with regards to a lot of the index changes as well. So that explains that there is not big moves happening in the large cap names today. The mid cap continues to outperform, so that's a bit of a positive sign. But again, even there, the feedback is maybe some signs of profit booking as well in select mid caps as well. I guess the theme which is going to dominate from here is going to be the earnings, and to start with, the two big IT numbers will report. So that's something to track as far as market cues are concerned. Also, the sense I'm getting is maybe next week you'll see the large caps, especially the likes of Reliance and HDFC, largely in focus because of the corporate development. So today HDFC Limited ceased to exist, and Monday is the day when the merged entity will start to trade. So that will be an important trigger for HDFC Bank. And of course, 28th is when the demerger, the record date is there for Reliance, Jio Financial Services. So those two are going to dominate as far as market trends is concerned next week. But largely in today's trade, a lot of flows are mixed because of its adjustments, and the momentum in mid caps continue. That's the broad feedback.
What about individual stocks, Nimesh? And particularly on just 1 minute on Delta Corp, have you heard anything?
So I can't miss Delta. That's been the biggest loser today, and huge volumes as well. So that's my first stock. Down after that, surprise GST announcement which has come, and big reaction as well, right? And the stock was actually overbought as well for the last many days. So huge volumes, but I understand at lower levels, some nibbling has happened. A large HNI investor and a leading domestic mutual fund was a buyer in today's block, and there were some blocks as well in Delta Corp. So the delivery volumes are quite high, but I understand there has been some buying as well from some smart guys. So that's the first one. The second stock is Patanjali. Again, in Patanjali, there was a block in middle trade, close to 11.5 lakh shares got changed hands. And I believe in Patanjali, a leading FI investor was a buyer in today's block. Remember, in Patanjali, the promoter block is still pending, which can come through via QIP as early as next week. So that's something to track in Patanjali. The third stock is Ashok Leyland. We've seen a big move in a lot of the auto stocks in the last many weeks now. Ashok Leyland now stands out because there is constant delivery buying happening from a leading FI in Ashok Leyland. So that's the reason it's come to my charter list. And the last stock is Indus Tower. Again, this is one stock which has been quite active as far as trading is concerned. Big volumes as well at HNI desk. But for a change today, the feedback is there are large sell flows at a leading FI desk in Indus Tower. So the delivery volumes are going to be quite high, and that stock is marginally under pressure today as well.
Okay, thank you very much for that. Interesting to note that Delta Corp, I think some domestic mutual funds in HNIs are buyers at lower levels. Thank you very much for that insight. The Nifty is in the red now. It's down close to about 65 odd points, while the sensex is holding up with a marginal green. Mitesh Thakkar is with us for a few BTST calls. Mitesh, what do you have on your list?
I have one buy and one sell call. On the sell side, or STBT call is on Gujarat Gas, which recommends taking a tight stop at 474.5 and a target of 460. And on the buying side is Zydus. Zydus is a BTST with a stop at about 587 and a target of 601.
Okay, all right, Mitesh, thanks a lot for that. Well, let's go across to Mayuresh Joshi, who joins us to help us out with some fundamental analysis. Hi, Mayuresh. Good afternoon. Mayuresh, I want to ask you about the cement space, because there were two big brokerage notes that came in earlier today. So I'm going to just run our viewers through that, and then I want to know your view, how you want to approach the space. Now, the two big brokerage notes on cement that came out earlier today, and both of them have contradictory views. Nomura, well, they're positive, while UBS is cautious. Let's start with Nomura first. They believe that we are in a strong near-term up move, and the drivers which outweigh the structural challenges. So they say the positives outweigh the negatives. They have observed that in the past 4 election cycles, the industry records its highest volume growth in the pre-election years. And they have forecasted that cement demand over the next 2 years, that's FY24 to FY26, well, it will grow by around 5%. That compares with around 3.8% that it's grown in the last 10 years or so. They remain positive in the near term due to the moderated input costs, and they're expecting the EBITDA per ton to improve by 30% on a year-on-year basis in the coming fiscal, though they admit there's limited ROCE expansion potential due to the large underutilized asset base and also the flattish cost structure. Their top pick is Dalmia Bharat, as they believe that there is potential to become a pan-India player in the near term, while they have a reduced rating on Shree Cement, as they are losing the cost advantage that they had, and also they're moving away from their core market, which was North India. Now, moving to the cautious view, then UBS, well, they are cautious on the cement space. They have a contrarian negative view. That's because of the rising competition as well as expensive valuations. They say that any sharp uptick in the stock prices is a good opportunity to book some profits. The key reasons that they have highlighted is that demand is likely to slow after the general elections, that's post-2024. Capacity addition is likely to exceed the medium-term demand. They also expect players to resort to pricing to grow or defend their turf. And they also see limited room for value-accretive M&A. They're positive though on ACC. They retain a buy call out there. They've tapered down their target price on that one, while on other names, they've cut their ratings, and they have a contradictory to Nomura. They have a sell call on Dalmia, which Nomura is most positive on. Mayuresh, what are you making of the cement pack? Two views coming in there. After a while, actually, I have a negative view coming in from a brokerage, from UBS on cement, because everyone's saying cement's going to grow. India needs cement, whether it's infrastructure, real estate. It's a good way to play. Do you agree, or would you be a little bit cautious after the recent run?
Afternoon, Nigel. So I think from a structural perspective, obviously, I think cement is a very good space to be in because all the macros that we are speaking about, and you just spoke about, government capex, private capex coming through, expectations in terms of more investments happening both in the real estate, stroke infrastructure, stroke construction sector, will prop up demand for cement over the next few quarters and years. Having said that, the recent corrections that you've seen in input costs, specifically pet coke prices, have come off significantly. That's going to be a huge addition in terms of the EBITDA per ton, because you're going to see a straight addition in terms of cost savings from this aspect. The other element in terms of crude prices being low, freight costs are expected to also play out very, very positively for cement companies on a year-on-year basis as well. The third aspect in terms of the WHRS plants and the captive power plants that they're probably using, even power costs are expected to have a significant reduction on their balance sheets. And therefore, I think input cost reduction is a big positive. When it comes to the overall volume growth for the sector as a whole, Nigel, our own expectation over the next few years is that capacities, even if they start building up, both in terms of clinking and grinding units being put through, demand will also catch up significantly, and therefore utilization levels should exceed 75%, creating a natural operating leverage onto balance sheets, and therefore reported EBIT and reported EBITDA per ton should be relatively better. Last 2 quarters, just to put in perspective, a lot of volumes have been pushed through at the dealer level, and therefore inventory buildup has been very, very obvious. Q2 is obviously expected to be muted for monsoons, but second half can be pretty strong in terms of execution. So we remain selective because a few stocks on our own lens where the PSRS ratings look extremely strong with good institution holding and expectations of these theses playing out will be able to take cement. So valuations can always be an argument against it and Dalmia.
Mayuresh, do stay on. We need to get into a break. We'll come back and we'll be closer to market closing also. Welcome back. In conversation with Mayuresh Joshi, Head of Equity Research at William O'Neill. Mayuresh, what's happening with BSE? Big volumes, sharp surge in the stock price. Anything that you've picked up?
Rima, I'm so sorry. Could you repeat the stock name, please?
BSE, Bombay Stock Exchange.
Okay. So again, I think normal, activity in terms of demat accounts being added. I think darling in terms of the COVID fall and the recovery thereof. Not specifically heard anything in relation to what is particularly happening. But I think the kind of business model that they've probably got in terms of trading action and transaction value probably remaining stable. Annuity incomes are probably expected to remain stable as well. And therefore, the cash that they probably have in the balance sheet creates a further accretion onto the overall reported earnings as well. But nothing specific that probably happened.
All right, Mayuresh, very quickly before we let you go, HCL Tech and TCS, they come out with their numbers in the next 120 minutes. What's your view on them? If the numbers are weak, will you look to buy into any of them?
No, I think we'll still wait it out, Nigel. I think two things. One, I think for the sector as a whole, specifically the large caps, I think the expectations are very, very muted, which is a very good sign. Because if they deliver as per market expectations and the under-delivery is not too significantly worse off than what the market was probably believing, my sense is that there might be just a knee-jerk reaction on these stocks and they might then consolidate, looking at what the management commentary is all about. But a large part of the expectations in terms of muted revenue growth for TCS in particular, the added EBIT margin pressures because of wage payouts, and commentary in particular, looking at how BFSI retail manufacturing will actually play out, is going to be extremely critical. On top of that, how the utilization levels probably play out for the sector as a whole is going to be extremely, extremely critical. So everything hinges probably in terms of management commentary at this stage. And secondly, I think if the numbers are not too worse off than what the market is probably believing, I think the markets will take that into account.
Okay, all right, Mayuresh, thanks so much for stopping by and giving us your view on those stocks. Just next couple of hours, we'll have the numbers and Rima is going to have a very, very busy evening today. Well, let's wind down the markets then. It was actually a bit of a down day, but as we pointed out earlier in the morning itself, 19,360, 19,370, that was the crucial support zone. Well, it held on to that level. For the Nifty Bank, well, it suddenly lost its way. It was showing some bit of fight in the trading session, but then it lost its way. And that stock, in fact, that index itself ended with a cut of around 100 points odd. The body was in the mid-cap space. The mid-cap index ended high with a gain of close to around 0.4%. Though in terms of advance decline ratio, it was pat in the middle. Equal number of stocks advancing as well as declining. ONGC did well. Overnight, you had a bounce in crude oil prices, stronger demand, and weaker dollar. That's what boosted it. And ONGC was higher. Eicher Motors is slowly pulling back some of those losses that we saw in the past week. But this week itself, it's up 3.5%. Nestle India as well was up close to around 1%. On the flip side, Ultratech Cement was down 1%, Tata Motors was down close to around 1.5%, and Adani Enterprises as well, down 1.5%. But ladies, the mid-caps, that's where the action was. Tell us more.
Well, let's just once see the closing rates on TCS and HCL Tech to understand the market reference once the numbers come out. TCS is closing in the red with a cut of 0.4%, but it recovered 1% from the day's low in the second half of the trading session, so some buying emerging. HCL Tech continues its weak run. Today, it's down close to about 0.5%, but in the last 5 trading sessions, the stock has seen a fall from levels of 1,200, now down to 1,100. A quick run through of some of the big movers in the mid-cap space that we had. Zentech is one which stands out, so that should deserves mention. BSE 8.5% higher. You've had strength in Amara Raja, Lupin, where there was some positive news on the regulatory front. Balkrishna Industry higher in trade, HDFC, AMC. Across sectors, there was buying, but Delta Corp, right?
23%.
23%, very large volumes.
Absolutely, and that's the one. I mean, stock of the day for the wrong reasons, thanks to the GST developments. Nazara, not that bad, 3% lower on Nazara as well. But barring, these two big headlines on the downside, the mid-cap market continued to have serious momentum. There's so many stocks. Look at Mankind Pharma, 9% up, Paytm 6%. Some of the stocks like Genus Power that Nigel was pointing out on the smart metering side, very, very strong moves on these stocks. But on the Nifty, I guess it's very, very clear that 19,500 now we can safely say is a resistance. 5-6 trading sessions, the market has been grappling with that level. It has either intraday gone there and then fallen off, and today has been a sort of decisive climb down. In fact, we're probably getting a close below the 19,400 mark as well on the adjusted basis. So there goes the bell. Cut off around 55 points on the Nifty, but the mid-cap party continues absolutely uninterrupted. Okay, well, on that note, we will get into a quick break right now. It is a wrap from the entire Closing Bell team. Many thanks for being with us, but don't go anywhere because our Wednesday special Mad About Markets coming up next.